Well, with markets at records highs and a Fed cut coming down the pipe, our next guest says, keep buying stocks. Let's bring in Phil Camporeale from JPMorgan. Phil, welcome back. Good to have you. Sorry to have to squeeze you in over there.
This market's so exciting. We need 6 of you guys.
Kind of crowded here. Don't fight the Fed. Isn't that what we've been doing strategically since the lows in December when we've rallied 27% or so?
It's just incredible, Melissa, to talk about this market here. I mean, we're coming off the best first half in over 20 years, best June in half a century. You have the longest expansion now, so expansion the distance between 2 recessions that we've ever seen since World War II. So of course you should have a Fed that's tightening rates, right? No, the Fed is easing rates here. And you know, I know Guy's a baseball fan, Reggie Jackson, 1977, the straw that stirs the drink. That's who the Fed is right now. And the don't fight the Fed playbook is have U.S. equity in the portfolio from a financial conditions argument, right? Not necessarily because you believe earnings are going to shoot the lights out, but financial conditions are so easy. But also make sure you get some carry or yield in the portfolio. I can't believe we're saying this again. I feel like it's 2011 all over again. But this is the story. It's the don't fight the Fed story. Now, why is the Fed easing? Is the Fed easing because inflation is slipping a little bit from the 2% down to about 1.6, 1.5, and they have to recalibrate 1 or 2 easings? If that's the case, we're going to be right on equities. If the Fed has to go 4 or 5 times over the next year, look out below on equities, right? So why is the Fed easing, I think, is really important right now.
Does valuation not matter?
So if you're using valuation as a determinant, 16, 17 times is not expensive on a PE standpoint, forward PE standpoint on the S&P. I think trade is going to put some sort of a ceiling on whether investors can pay 18 or 19 times. So there is some sort of ceiling on multiple expansion from valuation standpoint, which is where the high yield story comes in. And also, just buy a call on the S&P. If you buy a call on the S&P at the money, you get the upside protection, and it's the hockey stick diagram. You limit your downside.
So, you know, we look at where interest rates are to figure out what the right PE multiple is.
Yeah.
If interest rates are 0, what is the right multiple for the market?
You're going through 20 on that, right? So that's
I mean, it's infinite, but I don't know what the
that's an important
20.
That's an important consideration. But if interest rates are at 0, that certainly means that you're in a very bad scenario, right? So you can't really look at it that way. Also, what is the fixed income market telling us? At 2%, 210, 195, whatever some people are saying, are we going into recession? We would rather look at credit spreads for that signal. We're at 2% for a lot of reasons. Most notably, the Fed's balance sheet is gigantic, and instead of hiking, they're easing, and there's no inflation.
Phil, I don't think the Fed's going to cut 4 times, and I don't think you're saying that. But I don't know that the Fed's going to cut I don't think they're going to cut 2 times. And I think this is a market that's been priced for at least that. So what is your sense on that scenario?
So it's 1 meeting at a time. We think they're going to go in July. Okay, chances are
25.
they go 25 in July, and then it's a cost-benefit analysis after that, right? So if the cost of them using another bullet, they have 9 bullets, they raise rates 9 times. If that cost of using another bullet is greater than the benefit of them being put in a better situation to reach their inflation mandate, they'll go. We think it's 1 or 2, Tim, only because we have a trend 1.5 to 2% GDP growth rate on this economy, and they're recalibrating rather than starting an easy
That doesn't sound convincing to me. To be long equities at this point. We know 100%, I mean, at least according to Fed Funds Future, 100% chance of a 25 basis point rate cut in July. The rest of it sounds sort of a little, you know, in the air, in the ether. And so with where we are and where we've come in the markets, what is the balance of the risk reward at this point?
It's very low in terms of earning expectations. Equities can clear a 4% earnings quarter. They can also put a 2% dividend yield on top of that. Maybe a little bit of multiple expansion, which gets you to 6 to 7% over the next year. So this isn't fist-pounding double-digit return on equities here. But on the downside, financial conditions are so easy. Over the last decade, you've been proven that if financial conditions are easy, investors are going to climb the wall of worry. And that's really where we're coming at. It's not GDP growth is going to be 4 and equities are going to take off. It's more the fact that the Fed is going to keep financial conditions so easy that the consumer is going to love their mortgage rate, right? And that's going to keep the economy growing a trend, which then causes a grinding higher move in the equity market.
Phil, thanks for coming by. Good to see you. Phil Camporeale at the end of the desk. A lot of people
I know
here.
And Phil does a great job. I know we always want to make this more complicated. It has to be. I am guilty of that almost on a nightly basis. Sometimes it's just that easy, to Phil points out. And I'm not suggesting that's a dumb view. That's the right view. But with that said, the warning signs continue to be that Russell can't get out of its own way. You know, the precious metals market within a couple days or so continues to rally. You still have 24% of sovereign bonds globally with negative yields. Those are all concerning things. Obviously, equities don't care. Next week and the following weeks, I think, for the first time in a long time, earnings are going to matter a great deal.
At least from industrials, we've gotten a couple of data points already
Not
that
good.
indicate the impact of the China trade war, BASF, and then this morning, Fastenal.
Yeah, I'll just say this. So in October of 2018, when the S&P 500 made a new high at 2945 or something like that, the upside downside risk reward was not favorable. It was also the same case back in April, okay, when we made a new high just by a squeak, 2950 or something like that. Now we're at a new high. You could say the same thing, but Phil made one really important point. You can buy a call at the money. The SPY that tracks the S&P 500 closed today at 2950. You could buy the 1 month out August expiration 299 call for 1.5% of the ETF price. And when you think about that, so if you're watching the show and you're a trader, and you probably also watch OA that Tim was on last Friday, that is a really compelling risk reward that you get a lot of earnings and you also get the Fed announcement.